And we're live.
Yeah, we're live. Thanks everyone for jumping on. You got James Zhang with Whole Capital, James Wilson. We decided to go with the leasing office look today for our backdrop. So I appreciate everyone coming on. So we're discussing syndication today. So while people come in, maybe in the comments, just drop where you're coming in from today, whether it's Dallas or Austin, wherever across the nation. Just let us know in the comments where you guys are coming in from. And we're going to try to make this as interactive as possible, sort of like put up the whiteboard and just sort of draw it out for everyone out there. So James, when I say syndication, what is the first thing that comes to mind on syndication?
First thing that comes to mind for me is multifamily syndication. You can syndicate in a lot of different businesses, I guess, but we usually do multifamily. So syndication is a group of people coming together to, buy these multifamily properties, because some of them, could be 20, $30 million, and one person can't well, some people can, but most people can't just put 10, $15 million down. So they syndicate the deal, raise a bunch of money from investors, and they take the deal down that way.
All right, so we got Joseph from Tyler. We got Jay coming in from Allen, another guy from San Antonio. So thanks for jumping on, guys. So we'll jump in here and start going. So let me pull up the slides here.
Is my camera still going?
I think your camera froze up a little bit. If
Yeah,
you can,
it's frozen on my end.
Okay, maybe try to kill the screen and come back or something, and we'll start going here. All right. So while I'm doing a little intro, maybe James go out and come back in. Maybe. All right. So this is the agenda for today. So we're going to talk about sort of why multifamily syndication, GP and LP roles, so general partner and limited partner roles, pros and cons of syndication, building the team, and then really the GP comp. So how these guys get compensated for doing this deal. So, our background at Whole Capital, we've done, last year we did about 1.2 billion in loans. And then in the first quarter, we did about 160 million. So I think one thing you'll notice sort of on the large loans that were done in 2022, a lot of these were non-recourse bridge, like the top 4, 5, 6 deals. And then really in Q1, we saw really a transfer to Fannie and Freddie, right? So a lot of Fannie Mae, Freddie Mac conventional deals out there on the capital side. So my background, born and raised in Houston, went to school at UT in Austin. And then I was an underwriter for GE for about 10 years and then have been on the Whole Capital origination side since 2015. Done about 1.5 billion in multifamily loans. So I've seen a lot of different structures, a lot of different properties. And then I've invested in close to 40 multifamily properties across DFW, Austin, San Antonio, Houston. So, and then our big event. So we usually have monthly events, but our big event this year, October 4th and 5th over here in Dallas. So go to oldcapitalconference.com to learn more about that. And if you guys want the slides after this, so you don't have to take down everything, just send me an email and we can send you the slides as well. So, all right. So, kicking it off, a lot of people get into multifamily for these reasons, right? So cash flow, tax advantages, you've got third-party property management, diversified tenant base, the valuation is good, NOI divided by cap rate, you get good leverage, inflation, low volatility, you can trade on inside information, and you have control of the deal, right? So when you guys look at, this, why multifamily, for the people who are sort of here live with me, what are some of the main reasons that you guys invest in multifamily? So is it the cash flow? Like when I started, it was really about replacing my W-2. So I was more focused on cash flow. Like for people who are on live, like what is the main reason that you invest in multifamily today? All right. As comments come in, we'll take in some of the challenges that I see in the space right now. When you invest in multifamily, you've got illiquidity issues, right? So once you put money in the deal, it's sort of hard to get out of the deal. There's a large investment amount. All right, we got James back.
Hey, I'm back. Sorry.
All right, you're
I
back.
don't know,
No
my
problem.
camera
All right. No, you're
froze
good.
up there.
So we're just going through why multifamily. So why people should invest in multifamily. So, when I was getting started, I was focused more on the cash flow. So going back to sort of 2014, 2015, I was thinking, all right, yeah, most of these deals were like 10% cash on cash. So I was thinking more cash flow. When you started investing in multifamily, what's sort of the main reason for you investing in multifamily, James?
Yeah, I think for me, it was kind of the scale aspect and the math.
Okay.
I got a heavy engineering, MBA finance, like heavy math background. So
Okay.
when I started getting into the single families and just doing the math and I read a lot of books too. So I got down the rabbit hole of like, all right, what happens in real estate investors when they start out? When they go on the single family track, they eventually get to, 10 units and then they can't get any more loans, or they got to figure out a new way to get loans. And then from there, it just becomes more of a headache. And so the syndication model just seemed like, oh, you could do one transaction, one building, and have the scale. That was kind of my thinking behind syndication.
Yeah, I mean, some of the challenges I would say for multifamily that we were talking about was illiquidity, right? So you put money in the
Yeah.
deal. There's a large investment amount. You have to deal with partners. There's lack of diversification, right? So the way I like to think about this is when we're comparing syndication is if I'm buying a deal on my own with my own money versus me investing, like if I have $1 million, I could buy one deal, or I could split that $1 million into $100,000 chunks and put it in 10 deals, right? So that's how I want to look at this. But I mean, these are some of the challenges, and so I wanted to get into. All right, so these are some of the challenges of multifamily. I think the advantages far outweigh the challenges in terms of multifamily. But then, the next step really is how are people going to invest in the deal, right? So a lot of people that I talk to, when they come over from single family, they've done that all as an individual. And so when they come into multifamily, they're like, I just want to buy my own deal.
Yeah.
Right. So when you look
Heard
at this,
that before.
You've heard that before a couple times.
A few times, yeah.
A few times. So everybody wants to come over, buy their own deal, and they're like, the bank's going to give me all the money, right? And I can qualify for the loan. And when you're an individual, you have to sign on the loan. You're the asset manager. You find the deal. You get the tax benefits, but your job is to find the deals out there, right? But then maybe talk about the split between general partners and limited partners and sort of their roles, James.
Yeah, so usually general partners, team size can vary, but I would say we've done some of these YouTubes before where we said, 3 to 4 partners is pretty ideal. One for asset management, one for, finding the deals, kind of a deal hunter, acquisition person, and then somebody to raise money, or all 3 can raise money, but usually a general partnership team takes about 20% of the deal. Some go up to 30 depending on experience level, but I'd say for somebody coming in, a 20% split is pretty good. And then the money you raise from investors, they get 80% of the deal.
Okay, so the general partner, we'll use the airplane analogy that we always use, is the general partner is really the captain, and maybe
flying the plane.
was in the co-pilot. So the captain and co-pilot are really the general partners, and then the limited partners are the guys in coach or first class. Let's say coach, and
let's say coach, because some pref equity guys, they can be in the first class, right?
Yeah, so coach for the limited partners, and they're not signing on the loan. Nobody's asking them, how are we going to go into Denver today? They're just in the back seat, right? So they know the general direction of where the plane is going, but you're not consulting the limited partners every time the wind blows a different direction, right? So, so this is really the different ways of investing into multifamily. You got your individual, and then you got your GP LP. So this was a chart that I took out of some website around what syndication is, right? And so let's try to make this a little bit bigger. Hopefully you can see that. Maybe I'll blow it up here. So the GP is really the lead sponsor. They're going to operate the asset business plan. contribute the expertise. They're going to put some capital. They're going to receive equity and fees, and then the LP is going to contribute the capital and receive equity in return. So, so this, any comments on this or what you've seen on your side, James, in terms of syndication or what you thought it was when you were coming in?
I'm trying to think back what did I think syndication was? I just thought, you know, buying a multifamily was kind of the way to go. I guess I didn't really think about syndication, but you know, with podcasts and YouTube and everything now, you know, syndication is probably more widely known, but I think that chart right there breaks it down pretty well. And the airplane analogy really is a good analogy because the general partners are doing all the work, going to the destination, and the limited partners are just along for the ride. They don't really have any day-to-day duties, maybe pull the exit gate in case of emergency.
All right, so everyone has a good idea of syndication. So I'm gonna use this as sort of like a whiteboard. So let us know in the comments pros and cons of syndications. So pros and cons of syndications, and then we'll fill it in here on the whiteboard. What do you want to start with, James? Well, as people start filling in the comments, we'll start filling in the whiteboard here.
So we talked about scale was kind of one of the pros.
Okay, so like ability to buy larger properties.
Yeah.
Okay.
I saw a post on LinkedIn this morning that had a pretty good breakdown of why syndication. Somebody had bought operating businesses, and there's a lot of people involved in that, a lot of headaches. And you know, syndication is, depending on the property size, like 100 units is one in, one out, one person inside the office, the leasing office, and then one person maintenance. Or if it's like a 200 unit, 2 in, 2 out. But it's really not a lot of people to manage one of these bigger businesses. So I think that's definitely a pro.
Okay, so yeah, it's probably just a pro of multifamily in general, but we'll add it here in terms of I mean, you still need a body out there, right? If you buy a 10-unit deal, you still need a leasing agent, you still need a maintenance guy. But if you buy a 100-unit deal, you can have sort of one in, one out. And then I can't remember, like they opened up a Chick-fil-A here near me, and how many people do you think you have to hire for a Chick-fil-A to open up in your local neighborhood?
You need at least 4 people at a time on the outside taking orders.
Oh yeah, the to-go order, drive-through. Yeah.
So you need at least probably 12 to 20 people just on the schedule.
Yeah.
And then the inside, there's 30, 40 employees maybe.
Oh yeah, that's at one time, right? So
yeah,
I mean,
at one location.
Yeah, one location, and then that's from like 8 to 8 p.m. and then you got like a night shift. I mean, these guys can't work like 18-hour days. So, all right. Anything else on the pros? So you got scale, efficiency. What else of syndication?
Let's say cash flow.
Cash flow. Okay. So the way I want to think about syndication is if you're investing in the deal individually versus splitting up that $1 million into $100,000 checks. So to me, you get the efficiency, you get the scale. I would say diversification, right? You could be in 10 deals versus one deal out there. Anything else on the pro side?
Versus single family, single family is based on comps. So like in 2008, when every house started to crash, every other comp started to crash. So multifamily is based on how much cash the property produces. So unless vacancy is really high and delinquency is really high, like if you're collecting rent, your property will be valued based on the income stream. So that's a pro.
So that's all right. All right. Let's go back to this. So compare. All right. Pretend I got $1 million. So put this in text. And I had $1 million. So I have the option. Option 1 is to buy my own deal.
One building, one location.
One building, right? Or you take the $1 million. Option 2 is 10 deals at 100K a piece.
Is that as a GP or an LP?
LP.
LP. Okay.
I mean, it could be either, but let's just say it's as a GP, LP, as an LP. Sorry.
Okay.
So let us know in the comments if you had those two options. What would you take? Option 1, $1 million in your own deal. Option 2, 10 deals at 100K a piece. So that's the framework that when you're looking at this, how the difference between those two. So what about, all right, we'll come back to the pros. What about the con side of syndication?
So when you invest, that $100,000 into a deal,
Right.
it's pretty illiquid. That's not coming. You can't call up the general partner and say, "Hey, I want my money back." You're stuck in that deal until they sell it or refi it.
Yep.
So it could be 5 years, could be 7 years. Just depends on what the business plan of the sponsor is.
Yeah, I mean, a lot of deals have been flipped in and out like pretty quick the last couple of years, like 2-year hold, 2x return, let's go. But now if your plan was to sell this year and now you can't sell it, you might have to hold it for 3 or 4 more years. So it's going to be in that deal a little bit longer. All right, so Brian pulled up some stuff. All right, so cons.
Investor relations, buying skinny deals to raise rents.
All right, so I think, all right, so I guess this is from the GP side, is dealing. So yeah, I mean, we're going to talk about a $40 million deal later on in the deck, but let's say you're raising 15 million, 100,000 checks, $100,000 checks. That's like what, 150 investors.
So 150 emails, 150 K1s, 150
emails, K1s. What else?
Portal,
do you calls? Yeah.
It's a lot.
All right. And then what else did Brian say? So you got investor relations. So I think this is the second point is really maybe from the LP standpoint, in that you have to be GP might not be aligned with the LPs, right? So if they take in terms of fees, right? So if they're taking a big acquisition fee, they're taking a big disposition fee, and then the deal might be a little skinny. I think some GPs might just try to buy the deal, right? So
it's kind of been the game the last couple of years, right?
Yeah, so it might be a little bit difficult. Whereas like you as an individual, you might not buy that deal, right? So I don't know, Brian, maybe, do you get the last point, James? More work for less return. So I'm not exactly sure what that means.
Yeah, I think what he's saying is people are overpaying for deals, having to do a ton of work, because it is a lot. Syndication is a lot of work, dealing with 150 investors, and then because the market went down, you're not really getting as much return. So maybe that's
okay. So that's maybe from the GPLP side. That's
just because you've had to stretch so far for the last couple of years to get a deal, and then it seems like a lot of people are kind of reverse engineering their pro forma to make it seem like a 2x return. When in reality, it probably was not, unless interest rates remained at 0 for the next 3 years. But
yeah, okay,
that wasn't the case.
Yeah, someone asked about. Yeah, we're recording it, so we'll be able to put it up on YouTube and LinkedIn later after this. All right, perfect. So let's try to balance this out. So I don't think there's more cons than pros. So any other pros here? So we got scale, efficiency, diversification. To me, the biggest one is probably just a smaller check size as an LP. Like the 100,000 versus the $1 million check into one deal. And another pro to me is just really time, right? Like as an LP, like Like, how much time does it take you to invest as LP in a deal?
You just got to do a one-time startup headache, filling out all that paperwork, and then hopefully you don't mess up and have to go redo it. But yeah, it's usually just a subscription docs, and then wire the money and just wait for the K1 each year.
Right. So yeah, so you're leveraging your time. So you got scale, efficiency, diversification, smaller check size, time. All right. In the comments, let us know any other pros and cons of syndication before. So the reason that I started with this sort of multifamily chart earlier was, there's a lot of deals. Oh, we got one more. All right, here we go. We got Hugh jumped in here. So you get the benefits, tax benefits.
Yep. Cost segregation.
Yeah, tax benefits of for GP and LP. So so the cost segregation, you do the cost segregation for the bonus depreciation.
Yeah, so bonus depreciation, you're taking those. Usually it's a straight line depreciation for real estate for the building, but cost segregation allows an engineer to come in and take out those 5 and 15 and 7 year depreciable items, kind of like cabinets and countertops and stuff like that. So you pay someone to come in and evaluate your building, and it's usually about 30% of the building is that 5 to 15 year depreciable range. And then you could take all that depreciation instead of over like 15 years or 5 years, you take it in year 1 or year 0 and use it all up front. It usually ends up being around 30%. So if you leverage a deal, buy it, 70% leverage and put in 30%, you're almost getting a 1-for-1 for how much money you put in, for how much bonus depreciation you get in. Last year anyways, because it was 100%. It's going to be a little bit less this year at 80%, but it's still a pretty good tax component.
So we'll put down, so like if you put down 100,000, you might get like an 80K or to 60K negative on the deal.
I think some people need to be aware of, though, that you can't always use all of it unless you're a full-time real estate professional.
Right.
So that's something you definitely want to consult with your accountant, because a lot of people will advertise like, oh, you get all this tax benefits, but in some cases you can't always use them. So just be careful of that. But either way, there's still pretty good overall tax benefits.
All right. Awesome. So we built out the pros a little bit better now. So
what about inflation hedge?
So think about, go back to this example of, so like, let's say you bought a smaller deal. You might not want to invest, like, let's say you bought like a $2 million property or $1.5 million property. You might not do like the bonus depreciation on that deal, right? Because it's not worth it. Sometimes you have to pay $10,000 or $5,000 for a cost seg. Then you've got to get the accountant. You got to do the bonus depreciation. You might, especially on single family. I don't think on single family, no one's doing cost seg and bonus depreciation, I would think, on one house. Right?
If you do a short-term rental, there's some pretty good cost seg stuff you can get. But usually, like a long-term single family, you usually don't do it. But short-term rental, sometimes you can get some pretty good benefits.
All right. We had a question come in on managing a 40-60 unit for maintenance and leasing. What's your thoughts on that question, James?
Roll up your sleeves.
Self-management? You're thinking self-management on this guy?
No, I think you can get a part-time. You could get some sort of part-time leasing. Look for other similar sized properties in the area and see how those are being managed. Sometimes you can get like a package deal or some sort of discount if they have boots on the ground nearby. But it's definitely a little bit trickier than, let's say, 100 unit.
Yeah. Usually with a 40 to 60 unit, like we're refinancing one right now, they usually are doing at least one person on site. So maybe a very strong property manager, and then contract out the maintenance. And let us know where that property is, right? So here in Dallas, there's like pockets, right? So like in East Dallas, like there's a lot of properties that are like 10 to 50 units. And so that allows you to, congregate a bunch of properties together and run them sort of as one. And so, but yeah, I would still probably budget at least 1,000 a unit, maybe 1,500 a unit. So, for a property like that, so maybe 100.
We've got a pretty good event coming up tomorrow night, right? On asset management, property management. We got the professionals out in Grapevine.
Yeah, we're doing a property management speaker series tomorrow. So if you can make that, if you're here in Dallas, that'd be a good one.
Yeah, I'll try to live stream it on YouTube.
Okay. All right. Brian had a little bit on the GP side. All right. So you can build your team easier. Okay. So team of GPs do all the different aspects of management. Of syndication. Okay. All right. We filled up the page. So any other comments here? All right, let's keep going. All right, so pros and cons syndication. So we'll save this deck and then we'll send it out. Just send us an email. We'll send it out to everybody. All right, so I think I sort of prepped this in advance, but all right, so multifamily syndication, what does it solve, right? So what challenges does it solve, right? Is your investment still illiquid? I would say, yep, it's still liquid, it's still in the deal. Definitely, you still are dealing with partners, but your large investment amount now, instead of $1 million, it's 50 or 100, right? So it's pretty good.
Yeah, I mean, you could be a general partner on a $20 million deal for $100,000.
100,000, yep.
Which you couldn't be by yourself.
So you've got smaller investment checks. Now you could be in 10 deals instead of one deal, and then you've got access to deals. Whereas before, you weren't really looking at $20 million deals, right? And you're looking at $2 million deals on LoopNet. So now you're looking at $20 and $30 million deals. So you have more access to deals. So we'll touch on illiquidity and partnerships. Have you seen anybody been able to get out of these deals on the illiquidity side? Or is that usually at a penalty? What do you think?
I have not. I've yet to see people really get out of illiquidity. I think my camera's frozen again, but can you hear me at least?
I can hear you, but if you want to drop out and come back in, no problem. We'll keep going. If you want to drop out and come back in,
I don't think I've seen anybody that I know of really get out of deals. I've heard people complain and try, but I've yet to see it. Have you?
I've seen some people just buy people out, right? So if you've got an LP that maybe is a little bit more difficult, like they're asking you questions every week, like at the beginning, I think that's okay. But I mean, you also, want to respect your general partner's time, and you don't want to be, pestering them every week on a deal unless there's a huge issue, right? So if there's a huge issue, then I would say, yeah, that's fine. But you don't want to be that LP guy. So, all right. So building the sponsorship team. So if you guys can help me out on this one. So we're gonna build out the whiteboard here. And so who do you need on the sponsorship team? And I'll leave it up for the comments here. So as you build your sponsorship team, who do you need on that team? What roles do you need on that sponsorship team? So let me know in the comments that you've seen on the general partnership side. Who do you need to build that sponsorship team? So let's see. We'll start off with, let's go with, when you're first starting, you're going to need someone that's going to be able to find the deal for you, right? So there you go. So Jay, you got 2 for 1. So find the deal. And then the second piece is going to be, I think, fundraiser. So let's go raise equity, investor relations. All right. Let me put that in there. So you got find the deal, raise equity. So KP. So Sean, maybe like what's the KP going to bring? Jay also got loan guarantor. So let's say qualifying for the loan. Let's put this down here. So this could be, net worth, liquidity, multifamily experience, in terms of qualifying for the loan. All right, so we got investor relations, money raiser, perfect, operator. So the operator is really going to be around asset management of the deal post close, right? So those are really, so Brian, you got acquisition, management, operations, rehab. So I would say, yeah, I mean, that's actually a good point. So this is operations sort of day to day, but then also like if you have a big rehab component, managing that rehab can be a huge part. Sean was talking about balance sheet, liquidity. Perfect. So on the balance sheet, qualifying for the loan, you're really going to need somebody with the net worth equal to or greater than the loan amount. You're going to need liquidity of 10% or higher of the loan amount. And then you're going to need someone who's signed on multifamily loans before. So, and then Rob jumped in, someone with a track record. Absolutely. So this multifamily experience piece right here, that's going to be qualifying for the loan. So any other, so we got find the deal, we've got raise equity, investor relations, we got qualifying for the loan, we got asset management. Any other, do you need anybody else on the sponsorship team, or is that pretty good? Any other comments there on building out the team here? All right, so we're going to copy that over. So we're going to save that for later. Okay, so GP comp. So you've got those 4 people, and what are the 4 main ways that a GP is compensated for doing all this work, right? So I'll kick it off with, I think we mentioned this before, acquisition fee. How else are general partners getting compensated? So let me know in the comments how general partners are getting compensated on these deals for doing the work, right? Because we said it definitely takes some time. So understanding acquisition fee, when you buy the deal, you might have a disposition fee, or let's go with disposition fee. You sell the deal, and then asset management fee. All right, so you buy the deal, acquisition fee, you got asset management fee while you own the deal, and then you got a disposition fee, and then you got equity. All right, perfect. So we got, equity, this can be called carried interest. This can be called override, different words that'll be. All right, James, welcome back. So no worries. So just to recap real quick while we're jumping back. So we built out the sponsorship team. So we got the 4 sort of find the deal, raise the equity, qualify for the loan, asset management. And then, all these guys are going to have to get paid. So acquisition fee, disposition fee, asset management fee, or promote in there. Let's see. So
it's a lot of work.
Into the capital raise. Okay. All right. We got the promote. All right. Disposition fee. All right. All right. So James, out of these, which one is the most aligned with the LPs?
The disposition fee.
The disposition fee is the most aligned? You think so? So if I buy the deal and I sell it for a loss, but I still take a fee, is that aligned with the LP?
Wait, maybe I'm thinking something different. Maybe the equity carried interest.
Okay. So the equity carried interest. Okay. So when the LPs make money, then the GP makes money, right? On that comp, right? So we got acquisition fee, disposition, asset management fee.
I was thinking when you sell, you get your money back, or 2x.
Sure. Yeah. So you definitely will. So let's remember. All right, these are two charts that we're gonna take into the case study, right? So we're sort of building our our knowledge here. So we got find the deal, raise the equity, qualifying for loan, asset management, and then the GP comp. So acquisition fee, asset management fee, disposition, equity. So on most deals, the GP is going to receive anywhere from 20 to 30% of this override, right? Let's give some common the acquisition fee. What have you seen, James, on acquisition fees? Sort of typical acquisition fee out there on a deal.
I'd say standard is 1%.
1% of the purchase price.
Of the purchase, yeah.
Okay, 1% of the purchase price. What about
So
this
$20
million
million deal? You get $200,000 for the GP team, and they can kind of split it up how they want.
Okay, so 1% of. All right, what about this disposition fee?
Is that? I don't know if I'm right on disposition fee. Is that when they sell the property?
Yeah, when they sell the property.
It's like the split, the 80-20 split.
No. The disposition fee is just going to be a fee on top of when they sell it. It's not. Yeah, this is the split you're thinking is down here, the promote.
Okay.
So disposition fee, I mean, sometimes it's 0, sometimes it's 1% of the sales price. So you just have to look at like your PPM and that'll detail it out. And then asset management fee, what do you typically see on that?
1 to 2%, depending on the deal size.
The 1 to 2% of the income. So this you have to check this on your PPM and stuff, but asset management fee is typically 1 to 2% of your income at the property level. But I've also seen asset management fee be a percentage of the equity raised. So you have to check that, make sure you look at it correctly. And then override, equity, promote, carried interest. What are you typically seeing on this?
Seeing the 80-20 split or the 70-30 split.
The 80-20, so 80 LP, and then 20 to GP split.
Then you can get preferred returns. You can do waterfalls.
Maybe 7% preferred, then what, 70-30?
Yeah.
Okay.
And then a hurdle, 50-50.
Okay. So that's really the ways that GPs get compensated. So I'm gonna build that out a little bit here.
What would you say about this statement? If the more complicated the structure, the better it probably is for the GP.
Well, if you don't understand the structure, and you can't calculate the compensation, then yeah, I probably wouldn't invest in the deal, right? If it's getting too complicated, because you probably need some sort of fancy Excel model to really calculate it. And then, yeah, Brian, on the disposition fee, that's on top of the broker commission. So this is the disposition fee to the general partnership. So you just have to check the PPM to see what this is. Sometimes they'll put it in the webinar pitch presentation, but sometimes not. So, all right. So we got GP comp. All right. So let's go down. So we got the sponsorship team. All right. So now what I wanted to do is pretend you had the 20%. And so let's say you had the 20%. So let's say we're going for 80-20 split. And you had to allocate this 20% to these different things, right? The person, let's say there's 4 KPs or four people on the sponsorship team. All right. So what do you want the first person? Let's say all these people, you want to give them a name or you want to call it James 1, 2, 3, and 4?
I like the name James. Let's stick with that.
All right. James 2, James 3, and then James 4. All right. So we got the whole James sponsorship team here. All right. What's the first guy going to do?
He's going to find the deal. Get it
Find
under
the
contract.
deal. All right. Find the deal. What about number 2?
He is going to be a KP, loan guarantor.
So is he's just signing on the loan?
He's just signing on the loan.
Okay. All right. And then number 3?
Asset manager.
Asset manager. All right.
Boots on the ground, doing all the dirty work.
All right. And then what about number 4?
Capital raiser.
Capital raiser. Okay.
James 4 can raise $20 million in 24 hours.
All right. All right. So now this, all right, I'll throw it back to the audience here. So this 20%, so you got 20% to allocate to these GPs. How much are you giving to each one of these people on the sponsorship team? So put in the comments, let's say James won, he found the deal. How much of the 20% should we allocate to him? Any thoughts on finding the deal? Maybe James W.
James 0.
Yeah, James Wilson. What do you think? How much should we? What do you think? Maybe 10% or what?
I think the person that finds the deal and gets under contract kind of has a little bit of control of the deal, right?
Okay, a little bit more control. So what, you want to go 15?
20? 15,
so we got 20 to allocate out, right? So what are you thinking?
Oh wait, are we taking it out of 20? So like
it's got to add up to 20. So
okay.
Each one, it's got to add up to 20.
Let's give him 10%.
10%, okay.
He gets half of it because he's got the deal.
All right. What about KP signing on a loan?
You get 3 to 5.
All right. So we'll do 4. Asset manager.
3 to 4.
3 to 4. All right. All right. You're up at your total is 18 so far.
Capital raisers probably about the same.
4%.
Maybe we got to bring James 1 down a little bit.
Oh, James 1 splitting this thing up a little bit. Okay, so maybe go to 8.
Yeah.
Okay. So we got a comment around who's putting up the earnest money. Let's just go with James 1 finding a deal and
risk capital.
Yeah, they're putting in money on the deal. So earnest money on the deal. Make this a little bit smaller. Anything else on the?
If you got the power of one more GP, you might need to split up.
Yeah, I mean, let us know what you guys think in terms of, is this what you've seen on deals in terms of the sponsorship team? 8% to the guy who finds the deal, maybe putting up earnest money at the title company, person signing on the loan, the asset manager. So this would be like one example, right?
Yeah, I think everything's up for negotiation, right?
Right. So it's all negotiable. I've usually seen this top guy, if you're able to secure a deal like with a broker, usually you have multifamily experience, a track record on the deal, or that broker usually won't give you that deal, right? So I'm gonna bump this guy up a little bit here to 13%. Because he found the deal, he put up the earnest money, he's got the multifamily experience. KP, like when you look around, how many people usually have the net worth and liquidity at these, like when you go to networking events and stuff like that?
Usually, actually, you'd be surprised. There's actually a lot of KPs.
A lot more KPs, right? So to me, this is like a demand supply issue, or not issue, but like problem, right? Like if you've got 5 KPs who are willing to sign on your $10 million deal, then this goes down, right? So I'd probably put this at like 1 to 2%. I'll give it 2%. And then asset manager, so usually they are getting a piece of the asset management fee and not necessarily getting equity, depending on the deal. So let's just put this guy at 1%. And then I would say the capital raiser. So you cannot be classified as a capital raiser. You've got to have some other duties. So you can be a capital raiser, asset manager.
Well, don't by default you're investor relations.
Yeah, investor relations for sure.
Because you have all their capital.
Yeah, so I'd probably bring this down a bit. Let's see, investor relations. Let's go maybe 2%. So what do we got? 13, 2, 1, 2. So we got 2% more to allocate. Maybe go 2% on the asset manager and maybe bring a little bit more to the capital raiser on this one. So we got 13% for finding the deal, putting up the money, KP or key principal, 2% signing on the loan. Usually this first guy is signing on the loan too.
So you want to be James 1, right?
Well, so when you first start out, you're not going to be James 1, right? So when you start out, you might be sitting down here, right? You might be 2, 3, or 4, James 2, 3, or 4. And then after you sign on the first deal, let's say you're the asset manager for a deal, and then you sign on the loan as well, really to just sort of get your Fannie Mae card and, get your agency card and your experience card.
Yeah.
And then the next deal, you can get into it, right? So the more things that you can be on this sponsorship team, the higher value and the higher percentage of equity that you're going to get. So,
one question I get quite a bit is about loan guarantor. So some people will come in on the deal, but they won't sign on the loan, and they ask me, "Is that multifamily experience?" What's your take on that one?
To me, that is you're the same as a limited partner. Like you got some of the general partnership split, but you didn't sign on the loan and you have no management control. So usually if you want to qualify it as multifamily experience, then you're going to want to sign on the loan and be the manager of the borrower LLC.
Yeah.
Then that's experience to me. All right, I'm gonna make sure I save this file for people who want it post the call. All right, so we've got, let's go back a little bit. So we built the team. We saw the compensation across the GP team, and then we split up the compensation. All right, so we can kill that one. All right, so built the team, GP comp, split up the compensation. All right, so now we got about 10 minutes. Let's go through the case study here. And let's build out. So using everything that we know, so this is a $40 million purchase price deal. And the loan is $28.8 million. So here's the sources and uses on this deal. And this was the deal that we did last week. So if I'm sitting in the leasing office right here. So this is the Class A deal that we looked at yesterday or last week. So if you didn't watch that video, we go through the full thing. All right. So if I tell you this, 14.8 million in equity. All right.
So is that 72% leverage?
If you buy it, I can't do the math. 28.8 divided by 40. Yeah, 72. So it's pretty high. If you bought it for 40, I think it's going to probably go from more than 40, but let's just use 40. So based on what do you need now? So if you're trying to buy this deal, James, say you're James 1, right? And you're analyzing this deal and you get the 40 million. So knowing what you know, what we just covered, what do you need now? Like, let's start building the team.
I'm going to need the KP.
Okay. So the KP, what net worth and liquidity do we need to get to?
We're probably going to need around 28, 30 million.
All right. Let's say 29 million net worth.
29 million combined. Okay. Maybe I'm James 1 and I've done pretty well and I've got a net worth of 10, but now I need a KP to come in with the extra 19 to 20.
What? Yep.
Gonna need the asset manager because I don't want to manage the deal. I want to find the next deal.
Okay. So all right. So net worth, you need 29 million and 2.9 million liquid.
Liquid. Yep.
Yep. All right. And then you said asset manager.
Mm-hmm.
Okay. Manage the deal post close. All right. What else?
And then in case I can't raise the money, we need the capital raiser.
Okay. So capital raiser. And we got to raise 15 mil.
Someone who really, really believes in the deal, who can sell the story.
Sell the story. All right, perfect. All right, so like when you look at this deal, you got 40 million purchase price, you got closing costs of 1.2 million. Working capital is really the rehab, and then you got the acquisition fee of 400,000. So 43.6 million is your total cost into it, and then you've got to go out and raise 14.8 million. So let's keep this in mind as we go here. All right, so this was the top is the sources and uses, and then this is really the cash flow of the property, right? So you're getting to about 650,000 on your property cash flows in year one. You're going to take out the asset management fee. You remember we talked about the asset management fee is about usually 1% of the income. Then you got the sponsored cash flow. We use 20% on this example. I'll try to make this bigger because it's all right. So you have your property cash flow of 652. You got your asset management fee of 1%. You have your sponsored cash flow of 20% of the income, or sorry, 20% of this property cash flow. And then, so this is your passive cash flow. So year one, when you step in, you've got a 3% cash on cash. So that's your passive cash flow over the amount of equity that you had. And then every year, obviously we're going to be trying to grow the NOI. So the NOI is going to be growing. And so we're getting we're starting at 3%, ending at about 5.8% over the 5 years. Does that make sense? Any comments? Cash on cash average is about 4.6. What are you seeing right now on a lot of these deals?
Yeah, I'm seeing about 4 to 6 is the average.
4 to 6 average. Yeah.
Yeah, looks like my camera is being a complete liability on this live stream.
No worries. We'll keep going.
We got a couple questions there.
Okay, you want to hit? Yeah, let's finish up. Let's hit those at the end. I just want to finish this case study for the people who got to stay on till 11. So we've got the passive, we got the cash flow at 4 or 5%, and then you got your IRR. So we can still hear you, James. So you're good.
Yeah, I think I'll just stay on if you can hear me.
Yeah. All right. And then, all right. So this is the last piece that I want to cover. So now this bottom piece is the comp, right? So I'll make this bigger because I think this is important. So in the bottom here, so the asset management fee is a percentage of the income. So it's usually 1% of the income. So you get that on an annual basis. So that totals 228,000. The cash flow to the sponsor, this is going to be 20% of the net cash flow, the passive cash flow. So 130. So that's going to be a total of 915 over the life of the loan or life of the investment. You've got your acquisition fee in year one, and then you have your sponsor fee sales proceeds of 2.7 million. So total proceeds is 4.3 million. All right. So I put this little chart in the top right. So the LP, if you put 100,000 into this deal, you would essentially receive the 162,500. So I just did 12 and a half over the 5 years. So 162,500. So let me, so the GP, assume you got 4%, right? So let's say you are this guy, James 2, you signed on the loan and you got 4% of the equity. So I'm gonna let's see. I'm gonna show my calculator because I think this is important. All right, let's use the calculator here. All right, here we go. All right, let's kill that. All right, can you see the calculator?
Yeah.
All right, so if you put 100,000 in, you got 162,500. So let me see if I can do this math. If I can do this math correctly. All right, so the GP made 4,309,167, right? And then there was a 20%. 20% went to the GP, right? So that's about 215,000 over the 5 years, and this GP received 4% of the deal. So $861,000 for being a GP, right? So they signed on the loan and they got 833, and then they also put in 100,000 into the deal. So the 100,000 made 162,500. So their total for doing this deal on their initial investment plus being part of the GP, they made $1 million.
I want to be a GP.
You want to be a GP. So that is how general partners are making more money on these deals. So let me see. Let me go back to just the chart here. All right. So that is how GPs are making money on these deals. So I'll open it up. That was really the case study for today. We covered why multifamily syndication, like what challenges does it solve, the pros and cons of syndication, the difference between a GP LP, building out your team, how GPs get compensated, and then a little case study. So let's open it up for questions. Anything else that you guys are seeing out there on the syndication side that you want to address? In the meantime, we'll put in the comments any questions that you guys have, and we'll take them from there. Any wrap up comments, James, before we go into the questions?
I think we covered, a good deal of kind of how stuff's broken down. I think when we go over this stuff, it's really good for the audience because, I don't really remember reading or really watching anywhere any of that breakdown, So I think it's a good education for everybody, myself included, to just kind of learn, how deals are put together and how they're broken out. And I think the PPMs spell out a lot of that stuff too, right?
Yeah, I mean the PPM, like what I thought would be good is really around like once you have a foundation, when you look at 120 page PPM, like you don't even know where to start. So this at least gives you like a foundation of how to start looking at multifamily syndications, so that when you get the deck, when you get the PPM, then you have an idea of, okay, these are the things I should be looking for, right? Like what's the acquisition fee, disposition, asset management fee, what's the carry that the general partner has. And then once you sort of are familiar with these terms and you sort of know what they generally should be, you're trying to make sure that sort of what you're investing in is market. So
also it helps kind of see where people are at in their investing career and see kind of where they could fit in and kind of move up the ranks, go for
if you have like, if you go here, right, if you're saying, all right, how do I go from an LP to a GP, or how do I go from single family to a GP on a team? What do I need? What skill set do I need to build so that I can be on the team, right? So if you go meet somebody and they can raise equity and you can raise equity, you got two guys who can raise equity. Like that's not going to work, right? You need someone who's out there talking with the brokers, talking with us about lending, finding the deal out there. And then if all you do is find deals and raise equity, and you have no one on the backside making sure these deals perform, your career as a syndicator is going to be pretty short, right? Because your asset management's got to be good, or you're gonna have trouble. So
you mean it's not set it and forget it?
It's not set it and forget it. So that's for the LP, not for the GP. So the GP, you've got to stay in the deal a little bit longer.
There's no passive GPs.
There's no passive GPs from what I've seen. If you want to be a GP, and maybe I think you've got to set it up. So let's go back here. So if you want to be more passive and you want to focus more on the deal side, mm-hmm. I've seen people do that, but they've bumped this guy up a lot, right? So on the asset manager side, instead of giving them 2% or 1%, you're giving them 4 or 5% and saying, hey, after this deal closes, this is your baby. You run with it and make sure it goes the right way. You send out all the communications on a monthly basis. You do the videos, you deal with the contractors, all that type of stuff. So usually just cut that up at the beginning in terms of communication, I think is number one. So, all right, you want to hit some of these questions?
Sure.
All right.
What about if you have experience on one smaller deal, 10 to 20 units on your own? Would that qualify as enough experience for a big deal?
Do you want to take that one, or you want me to take it?
I think it's going to depend on, where you're located. If it's maybe, let's say you do a 20 unit deal in Dallas and you're looking for another deal in Dallas, maybe 75, 80 units, it might pass as experience. But if you're going to like a different market, or if it's a lot larger, it's got to be pretty similar, I think.
Yeah, I mean, 10 to 20 units, especially if you're like self-managing that deal, it's going to be, I don't think they're going to give you too much credit for that. I mean, you probably could go up to maybe 50 or 60 units. But if you do want to go up to maybe 100 units or over, you probably need to use a third-party property manager at that point, and then they're going to lean more on the third-party property manager and potentially do the deal at maybe instead of a 125 cover, maybe use a 130, 135 cover.
Yeah.
All right, let's hit the next one.
What difference in GP equity stake have you seen for earnest deposit that's refundable versus non-refundable? So I'm guessing how much earnest money you put down for non-refundable or hard money, usually like 1% of the deal amount.
Yeah, 1% of the purchase price is what we're seeing on earnest money. We haven't seen that much of a difference. Usually the person who ties up the deal, that first person, is getting, they're getting a majority of the equity for putting the deal together. So they're putting up, they're sort of setting the terms from the get on that. So we're not seeing a big difference, whether it's refundable or non-refundable. You're still putting up the 100,000 at the title company.
How, as a GP, would you justify to an LP an average of 4 to 6% cash-on-cash return when money market savings rates are 4 to 5% nowadays? Would you anticipate LP expectations for ROI to expand? Well, as an LP, that's just the cash-on-cash from the NOI or from the deal, and then there's more benefits to when you sell. You could get a capital event where you could get more money that way. So it's not just 4 to 5% in the bank. That's just straight return. LP investment, you got to factor in the overall return, not just the cash on cash. But I see what Sean's saying. It is pretty low cash on cash return.
Yeah, I mean, yeah, it's going to be the same. Like, can you see this Excel model that we pulled up? So this is the deal that we talked about. So yeah, you're getting anywhere from 3 to 5% cash on cash here, but then half of your return or more than half of your return is going to be really this net sales proceeds when you sell the deal, and so that's going to give you close to or more than half of your return is when you sell the deal for a profit. So if your cash on cash is similar, but then you also see the upside in the deal, then I think that's where people would take a look at it. All right, let's take the next one. Emmanuel, 5% acquisition fee.
It's all in the underwriting.
So I mean,
it's pretty high.
So yeah, if the question is like if someone is getting 5% acquisition fee. So I mean, you could let's just throw that in on this deal. I mean, it's not, so right now we had 4.3 as our total, and that was a 1% acquisition fee. So let's throw 5% in there. So now that person, the GP, is making 5.6 million. So I would always look at it as more of like a combination of those 4 or 5 things that we talked about, right? So you got the acquisition, you got disposition, asset management fee. So you usually can't look at one of those just in by itself. You want to look at in total, and does it work across the board? And I've seen sometimes when you can't take an override, sometimes when you do like a tenant in common or something like that, the GP will take a higher acquisition fee and not take any equity. So instead of doing 20% equity, I do the acquisition fee and I do a disposition fee, and I don't do the equity fee.
Yeah, that might work.
Yep. All right. All right. Nathan asks, in terms of financing, what do you see in today's market? You want to take that one, and I'll pull up a slide on it.
Sure. So bank loans right now are 7.5%, 8.5%. So the prime rate's at 8%. So usually the bank recourse loans are right around that percentage. They're not really giving much more leverage than the agency. I would say they're being more conservative and looking at more of a better debt service coverage ratio than trying to stretch out like a bridge lender.
Okay.
And then you
So
have
this is on the bank loan on the left side. Okay,
bank
so you can see
loans.
that. Okay, so yeah, bank loan 7.5 to 8%, 8.5 right now on the bank loan. That's recourse.
They are good for a new investor if you wanted to take down like a smaller deal, $5 million or less in loan proceeds. But it is going to be a high interest rate. I would recommend if you're a new investor and wanted to take a deal down that you go with try to get a Freddie Mac SBL, try to get 65, 70% leverage with that loan, and that interest rate's going to be probably 5.75%.
Right.
The 10-year did come down today, I think.
Get the parachute out.
We get the parachute out. It's at 3.4. So if it keeps going down, then that interest rate will get a little bit better. But 5.5% is a lot better than 8%. So Freddie SBL for a smaller deal, up loan amount from 1 million to 7.5 million in a primary market, or up to 6 million in a secondary. And then you've got Freddie Mac conventional. So that's going to be your higher loan amount. I don't have a lot of experience with Freddie Mac conventional, but it's kind of similar to Fannie Mae in their pricing structure and how they do the debt service coverage ratio. So loan amount won't really be much difference there. I do know a lot of people do floaters for Freddie Mac.
Yeah, Freddie Mac really is. They're good at floaters, but then I mean, we just closed the fixed rate loan with them, working on a couple of refis right now. So if you have a Freddie Mac floater and you refi to a Freddie Mac fixed right now, they'll waive that exit fee that you have on the deal. So that's number one. Number two, Freddie Mac SBL and Freddie Mac conventional, you have to go through the process and submit it up to Freddie Mac, right? So it does take a little bit longer. You've got to you got to sort of get your package together, get your sponsorship team ready, fill out your form, send it in to Freddie Mac. Freddie Mac usually sits on it for a week or two, sends you questions back, and then they approve it sort of at the end. So it's a little bit longer process compared to Fannie. So let's jump over to Fannie.
Yeah, Fannie Mae. So $1 million and up. The big difference there is that you're gonna have a yield maintenance period. So the further out you do your loan, like if you do a 10-year loan, you're likely gonna have a yield maintenance period of 9.5 years. So you're really gonna want to see how long you want to hold it and kind of tailor your loan to that term. So if you think it's going to be a short-term hold, maybe do a 5-year or a 7-year loan. But keep in mind the spread's going to be a little bit higher if the shorter the term you go. So if you go all the way out to 10 years, you could probably get 5.25% interest rate. But yeah, it really just depends on that business plan.
All right, and then wrap up with non-recourse bridge, and then I'll pull a Fannie Mae quote and just show people a little bit what we're working with. So go to non-recourse bridge though.
Yeah, so non-recourse bridge, it's going to be short-term, 3 years typically. Some do 2, and then you can have a couple-year extensions if you pass certain tests. But they're going to give you higher leverage. I would say they'd go average is probably around 70% leverage right now.
Yeah,
maybe up to 75%. They're going to give you the big thing that people like about the bridge loans is that they're going to give you rehab dollars. So you could get 1, 2, up, a lot of money, 1 to 2 million, or a lot of more money with the bridge loan for CapEx, whereas the agencies, excuse me, aren't really going to give you that CapEx dollars.
Okay, perfect. All right, so let's go over. So I'll show this real quick, and then so I'll just pull up a quote from a recent deal. I think we got this yesterday. Let's see. All right, here we go. So this is a Fannie quote. So what we were just talking about, and can you see that quote? Okay.
Yeah.
All right. So it really shows the differences between, I'll try to make it bigger. So if you look at, all right, so this is all based on the treasury, right? So you've got a 10-year loan here, and your spread's about 191. And then it has that 9.5 years of yield maintenance. But if you want a shorter term, you say, all right, I just want 7 years. That's fine. Your spread's a little bit higher, 207. And then you might have, 6.5 years of yield maintenance. And then if you want a 5-year, it's going to be off the 5-year treasury, and the spread is a little bit higher. And then you have 4.5 years of yield maintenance. So spreads around 2% is a good number to use. And then you can look up the treasury for the corresponding 7-year or 10-year or 5-year that you have out there. So any other questions? Or I think, let me see. Brian had a question. Let's see. If you can't get agency debt on smaller deals, I'm seeing SOFR plus 200, but not seeing cap rates expand. So Brian's asking about, he wants positive leverage on these deals. So if you're paying 6.5 to 7% on your interest rate, then what should you see as a cap rate?
It really just depends on what you as a buyer are comfortable with. We've seen some people do negative leverage if you believe in the deal. But yeah, I would say if that's your investment criteria to have positive leverage, then you would want to buy at a 7 or 8% cap rate, and then you would submit your LOI based on that purchase price. I don't know where we're seeing SOFR plus 200 outside of an agency, outside of a Freddie Mac floater, but say typical bridge is about 400 floating or 400 over SOFR.
Yeah, I think he's saying that even though the rate might be 6.5, he's still got to pay like 5.75 to 6 on a cap rate.
Yeah, it's still high. Yeah. Even 200 over SOFR is still a high interest rate.
Yeah, everybody's waiting for the rates to come down a little bit. So
yeah, when are they coming down?
Yeah, we'll find out. I mean, we'll have to wait and see. I think the Fed still got another 25 in them. It seems like out there. So I mean, but the market is still, when you look at the forward curve, I mean, if you go down, I mean, people are still projecting. The Fed is still thinking, hey, I'm going to hold up here at 5% by the end of the year. The market's saying you're going to have to cut soon. So, nobody knows, but you've got to protect yourself. If something breaks between April and January, then they're definitely going to cut, right? So, but it's been pretty quiet in terms of, I think in March, people definitely got scared in terms of, what's going to happen with the market. So everyone's sort of settled back in a little bit now. So, but I think that was it. Any other final comments, wrap up comments here? All right. I think we lost James. Well, I appreciate everyone jumping on. We'll be back next Tuesday with another live stream. Appreciate everyone with the comments and jumping on. And if you didn't catch the whole thing, definitely catch the replay. We'll put it up on YouTube, and subscribe and like the channel, and then you'll get notified when we put out any new videos. All right. Thanks, guys.